Hello everyone, you are watching Saheb Academy. If you like our videos, then please subscribe to our channel and also hit the bell icon for the regular updates, and also follow us on Instagram, Saheb Academy. Now let's go to the video.
Hi everyone, this is the third video of Profit Prior to Incorporation chapter, and in the previous two videos we have seen concept of this chapter and we have also solved one problem of this chapter. Yes, and if you haven't watched those videos, then please make sure you watch those videos first and then come back to this video. Okay, so I will put the links in the description below, as well as I will put the links in the I button. Fine. So now in this video, what we are going to do is, in this video we are going to solve another problem of profit prior to incorporation, but this problem will be very interesting. Why is that? Here we have got simple adjustments, okay, and it's very important to understand the adjustment, because in your exams you will get adjustments, so you must know how to solve a profit prior to incorporation problem when adjustments are given. Okay, and simple adjustment, so let's see. All right, so let's start. Now let's analyze this question. See, here we have been given S Company Limited was incorporated on 1/8/2019. So here they have said on this date, on 1/8/2019, this company, S Company, has come into legal existence. Why? Because this company got certificate of incorporation on 1/8/2019, that is 1st August. On 1st August, this company got certificate of incorporation and it got registered under the Indian Companies Act 2013. Fine. So this is what is meant by incorporated. And then they have said to take over the running business of Shivraj as a going concern as from 1/4/2019. So here they have said this company has taken over the business of Shivraj, right? It has acquired the business, or it has purchased the business of Shivraj on this date, on 1st April. Fine, on 1st April. Now this is what? This is the date of acquisition. And then I have told you in the previous video that certificate of incorporation, the date of getting certificate of incorporation, is the borderline. It is what? It is borderline. On its one side there is pre-period, that is before incorporation period, and on the other side there is post period, period after getting incorporation, right? That is the post period. So on one side pre and on other side post, right? Simple, right? And then they have said the following statement of profit and loss has been prepared for the year ending 31st/3/2020. So they have said the year has ended on 31st/3/2020 and they have given us statement of profit and loss. So year has ended on 31st March. Okay, 31st March. Now you can see we have got pre-period and post-period. Pre-period is from 1st April to 1st August, and post-period, it is from 1st August to 31st March. Yes, in this period there was company, because the company came into existence, into legal existence on this date. So here there is company, here there is no company. Fine. So the first thing that you have to do is you have to calculate the time ratio. How are you going to do that? How are you going to calculate the time ratio? See, it's very simple. See here, how many months are there in the pre-period? 1st April till 1st August, right? So April, May, June, July, only 4 months. Why not August? Because it is 1st August, so we'll not take August into consideration. August month will go into the post period. So here 4 months, yes, April, May, June, July, 4 months, and then the remaining is 8 months, right? In 12 months, if 4 are for pre, then the remaining is for post. Yes, simple, right? August, September, October, November, December, Jan, Feb, March. Yes, 8 months to the post. So now the ratio is 4:8. You can simplify this even further. 4 ones are 4 and then 4 twos are 8. So 1:2 is the time ratio. And then we need to find out the sales ratio. Yes, that is what we do at the beginning, right? We calculate the ratios. But now here you can see, now you will see, here we have got revenue from operations. In the profit and loss statement, they have given us profit and loss statement. It contains all the expenses and one income is given. Now here we don't have gross profit. We don't have gross profit. In the previous problem we saw there was gross profit, so we use the gross profit. Yes, but now here there is no gross profit, so we have to use revenue from operations. Revenue from operations means sales. Yeah, simple, right? Revenue from operations means sales. Now here it is given in the bracket. Yes, but in the exams they will not give you. You have to understand, they will just give you revenue from operation. Okay, so here revenue from operation is given. So here they have given us the whole figure. Right, now you have to see whether they have given any additional information regarding the pre-sales and post-sales, right? So we have to look. See, now here what they have said at last in the additional information, they have said the average monthly sales for the first 4 months during the year was 60,000 rupees. whereas the average monthly sales for the subsequent period was rupees 70,000. You see this? Now here what they have said, you have to understand. See, first they have said the average monthly sales for the first 4 months. Okay, monthly sales. Okay, monthly sales. So they have said, see here, let's draw another line. This is the date of incorporation. Okay, COI, that is August, right? 1st August. Now they have said in the first 4 months, monthly sales were 60,000, right? Average, they have given us average. So now we can understand on 1st April the year started. So April, right? April, let's say this is May, this is June, and this is July. Fine. So now here 60,000, here 60,000, here 60,000, and here 60,000. Simple, right? You understood, right? 60,000 into 4. Why? They have said 4 months, right? So 60,000 into 4. 4 6 are how much? 24. Yes. And then the remaining zeros, easy, right? So 2,40,000 is the sales of the pre-period. You understood? And then they have said, the average monthly sales for the subsequent period. Subsequent period means the remaining or the next period. For example, here they have given us information about the 4 months. Then out of 12 months, how many months are remaining? 8 months, right? So they have said subsequent period, that is the post period. 8 months period was 70,000 rupees. So the remaining 8 months are there, right? Till March 31st. Yeah, you're understanding, right? So here the sales were 70,000. Average monthly sales. These are monthly. Average monthly. They have said average monthly. So you have to do what? You have to do into 8. Why 8? Because it is 8 months. Here 4 months, then here it is 8 months. So 8 sevens are how much? 56, right? And then 4 zeros, 5,60,000. Simple. So this is how you have to find out the sales ratio. So we have got the sales ratio. Now we have to simplify this further, right? So how are we going to do this? See, it's very simple. See, now here we have got 2,40,000 in the pre and 5,60,000 in the post. So we have to simplify this. Now here I don't have space, so I will simplify this here. See, first I will do is I will cut the zeros, equal zeros, 4 zeros. Yeah, and then we have got 24 is to 56. Now both of this comes in the 8 table. See, 8 3s are 24 and then 8 7s are 56. So we have simplified this ratio as 3:7. So this is the sales ratio. Simple, right? So we have calculated the time ratio as well as the sales ratio. All right, and then we have lots of other working notes that we have to do. This was the first working note, the calculation of ratios, right? We have calculated the time ratio as well as the sales ratio. Now we have one more adjustment over here, that is the rent, regarding rent, and then we have one more adjustment here, interest to vendors. You can see this, interest to vendors. Now we'll understand this. Okay, here they have given up to 39/2019. This is usually done in the time ratio, but here they have said up to 39/2019. So we have to do a working note for this calculation. All right, so now let's do it. Now let's do the second working note, that is regarding rent and taxes. Now in the profit and loss statement, we have been given rent and taxes as 23,000. Yes, we have been given as 23,000, but you have to see in this there is rent in it as well as taxes. It is combined. Okay, so you have to keep that in mind. And then we would have allocated this on the basis of time ratio, rent and taxes, but here we have got an adjustment. In the adjustment it is said rent was paid at rupees 1,000 per month up to 1/8/2019, and thereafter it was increased to rupees 2,000 per month. You see this adjustment? Because of this adjustment we have to do some calculations. We have to prepare the working note. So now let's get the timeline first. Now what they have said in the adjustment, see here, rent was paid at rupees 1,000 per month up to 1/8/2019. So up to this date the rent was how much? Rent was 1,000 per month. Now which date is this? 1/8 means 1st August. This is the date of incorporation. So till here, till this period, the rent was how much? The rent was 1,000 per month. The rent was 1,000 per month. How many months are there from April to August? April, May, June, July, right? 4 months, isn't it? 4 months. So what are we going to do to calculate the rent here? 1,000 into 4. Yes, 1,000 is per month rent. So 1,000 into 4, that is 4,000. So the rent of pre-period, this is pre-period, yes, of pre-period is how much? 4,000. And then we have to see of the post period. See, of post period what they have said, and thereafter it was increased to rupees 2,000 per month. and thereafter means after this date. After this date, the rent was increased to 2000 per month. You see the remaining period. This is the remaining period, yeah. Here what happened? Here the rent was increased to 2000 per month. Simple. And here there are 8 months, isn't it? August, September, October, November, December, January, February, March. Yes, 8 months are there. So to calculate the rent, what you have to do? 2000 into 8 months, right? So it is equal to how much? 8 to the how much? 16,000. Yes, so now we have got the post rent. This is the post rent. Simple. So now we have got the rent of pre-period and post-period. So now we are directly going to take this into the P&L. Okay, into the P&L that we are going to prepare, right? Directly we are going to take. But here you can understand, if we add this 4,000 and 6,000, we get 20,000. Yes, but rent and taxes, here it is 23,000. The question it is given as rent and taxes 23,000. So you can understand now, out of this 23,000, if 20,000 is rent, if this is rent, total rent, then the remaining is what? The remaining is taxes. The remaining 3,000 is taxes. That is why it is 23,000. You understood? So now here what you have to do, directly you have to take 4,000 into the pre column and 16,000 into the post column, and then you have to do remaining 3,000, that is the taxes, on the time ratio. On the time ratio, you have to do this in the time ratio. If you do this in the time ratio, you see 3,000. Okay, let's do first of pre. What is the time ratio? Time ratio is 1:2, right? Time ratio is 1:2. So 1:2 means 1/3. This is the pre, and then 3,000 into 2/3. Yes, this is the post. This is the pre and this is post. So if you do this, 3 ones are 3. Yeah, so 1,000 is pre and post is, yeah, 2 ones are 2,000. So 2,000 of taxes goes to the post period and 1,000 taxes goes to the pre period. So now how much we have got? Rent is 4,000 in the pre period, rent is 16,000 in the post period. So you have to add all this. See, 4,000 plus 1,000, pre, both pre you have to take together. Okay, so 5,000 will go to pre. Simple. 5,000 will go to pre. 4,000 plus 1,000, rent and taxes, right? So you have to take rent as well as taxes. Same with this also, rent and taxes. So 16,000 plus 2,000. So 16,000 plus 2,000, that is equal to 18,000. So 18,000 will go to post. Simple, right? So this is how you have to do the rent adjust. It's very simple, right? Here we have got pre-period, here post-period. Fine? Okay. Now after preparing 2 working notes, now we have to prepare the 3rd working note, that is of interest to vendor, right? Here in the profit and loss statement, we have been given interest to vendors up to 30th September 6,000. We have been given 6,000. Now we have to split this 6,000 into pre and post. Yes, that is what we do. We split things up here. Now first you have to understand, why are we paying interest to vendors? Yes, you have to understand the concept behind it, and you should know who is this vendor, right? Now here in this problem, Shivraj is the vendor. Shivraj is the vendor because this S Company Limited took over the business of Shivraj, right? It took over the business of Shivraj. It purchased the business of Shivraj. It acquired the business of Shivraj, right? So this S Company Limited has to pay something to Shivraj so that it can take over or purchase the business of Shivraj. Yes, that is how you purchase things. You have to pay for them. So now S Company Limited is supposed to pay to Shivraj. They have to pay something, and that payment is called purchase consideration. That is called purchase consideration, and this can be in form of cash as well as in form of equity shares. Fine. Now here what has happened, here they have given us interest to vendor up to 30th September, right? Up to 30th September. The interest has been generated up to 30th September. Actually it means, let's understand here. See, on 1st April the business was acquired. Yes, and this S Company Limited was supposed to make this payment on 1st April itself. But sometime what will happen? Sometime there will be a delay, right? It may be paid later on, maybe May, June, July, August. But here in this case, it was paid on 30th September. It was paid on 30th September. What was paid on 30th September? the purchase consideration. The purchase consideration, the money was paid on 30th September. How did I come to know that? Because the interest has been generated till 30th September. That is what happens, right? Until and unless you clear the bank loan, just for an example, until and unless you clear the bank loan, the interest will keep on generating. Yes, that is how finance works. Yes, you have to repay the outstanding amount along with interest. Yes, so here also the same thing has happened. The amount was supposed to be paid on 1st April, but it was outstanding. There was a delay here and it was paid finally on 30th September. So interest was generated from 1st April till 30th September. You can see interest was generated from 1st April to 30th September. So April, May, June, July, August, September. See, 6 months. 6 months interest has been generated. I have taken September month also into consideration, okay, because it is 30th September. Fine. So PC was paid, purchase consideration was paid on 30th September. That is why the interest has been generated till 30th September of 6 months. So directly you can see if interest has been generated till 30th September, then 4 months, 4 months are of pre-period, right? 4 months interest are of pre-period, and this is the borderline. Yes, this is the borderline. That is the date of incorporation is the borderline. So 2-month interest has been generated in the post period. So 4-month interest has been generated in the pre-period and 2-month interest has been generated in the post period. You're understanding, right? 6 months in total, 4 months in pre and 2 months in post. So now we have to calculate the interest. We have been given the whole figure, that is of 6,000. Yes, interest to vendor 6,000. So we have to split this up. Yes, now it is easy for us. Why? Because we came to know now that out of this 6,000 interest of 6 months, 4 months interest is of pre-period and 2 months interest is of post period. Yes, so we can easily calculate. See, how are we going to calculate? 6,000, that's the total interest. Yes, total interest 6,000. So 6,000 total interest, but we want of pre, right? So how many months in pre? In pre there are only 4 months. So we want of 4, but in total it is of 6 months. This is 6 months interest, right? 6 month interest. It is in total it is 6 months, but we want of only 4. So let's calculate. See, it's very simple. 6,000 in total. We want of 4 into 4 divided by 6. It is of 6. So 4,000. In total it is 6, right? So 4,000. So 4,000 interest is of pre-period. 4,000 interest is of pre-period, and then easily you can calculate this also. Or you can say if 4,000 is of pre-period, then out of 6,000 the remaining is 2,000, which is of post-period. Or you can calculate. See, it's very simple. 6,000 is the 6,000 is the total interest. We want of 2 months. Why 2 months? 2-month interest has been generated in the post period. Yes, so 2 months divided by the total, that is 6 months. Yes, so 2,000 is the interest of the post period. Fine, so we have got the interest directly now. 4,000 will go to the pre column and 2,000 will go to the post column. Easy, right? It's very simple. You just have to understand, okay, how many months go into the post period and how many months go into the pre period. And you can easily do that by understanding this borderline, the borderline of incorporation, getting the certificate of incorporation or date of incorporation, whatever you can call it. Fine, simple, right? So this is how you have to do the working note of interest to vendor, right? And it is the interest to vendor on purchase consideration, not interest on capital. Okay, interest on capital is different. This is interest to vendor on purchase consideration, and mostly this will come in exams. Okay, right? Simple, right? Okay, now let's prepare the profit and loss statement. Now finally, here's the statement of profit and loss. See, it's very simple. To prepare statement of profit and loss, we are going to deduct all the expenses from income to find out the profit. Simple. So first thing that we are going to take is the sales. Why sales? Why not gross profit like in the last problem? Because here in this problem, in this question, there is no gross profit given. So we are left with no choice, right? We don't have gross profit. So what are we going to do? We are going to take the only income which we have, that is sales. So we took sales. Okay, now here the sales were of whole year, 8 lakh. 8 lakh sales were given, but we had to find it out by preparing the working note, right? We prepared the working note. See here, you remember this, right? Or did you forget? See what we did. We saw in the adjustment which said that average monthly sales of the first 4 months were 60,000 monthly sales. That means we had to multiply it with 4. So then we got 2,40,000 as the sales of the pre-period. So if we have the sales of the pre-period, then we can immediately know the sales of the post-period. How is that? Because we have total sales. We have total sales, that is 8 lakh. So if total is 8 lakh, if total sales is 8 lakh, yeah, then, and you come to know 2,40,000 sales are of pre-period, then if you subtract that, then whatever that is left, that is what? That is post sales. Yeah, 5,60,000 is the post sales. Or you can do the calculation. They said in the adjustment that 70,000 is the average monthly sales, so 70,000 into 8, because 4 months has gone to the pre-period, then the remaining is 8 months which has gone to the post period. So 70,000 monthly sales, average monthly sales into 8, you get 5,60,000. Yes, so 2,40,000 and 5,60,000. So this is how we found out the sales of the pre and post period. Simple. And then we had only one income, right? So total revenue was with only one income, 2,40,000, 5,60,000. Simple. And then you need to deduct all the expenses one by one. So first expense we have is the cost of sales. Now cost of sales is directly related with what? Sales. Simple. It is directly related with sales. So usually it will be done on the sales ratio unless and until there is an adjustment regarding it. Okay, so 6 lakhs will be done on the sales ratio. Now what is the sales ratio? Sales ratio we found out, right? Sales ratio is 3:7. Yes, 3:7. So cost of sales 3:7. Sales ratio 1,80,000, 4,20,000. We calculated that. See, the total is 6 lakh. 6 lakh. Yes, cost of sales is 6 lakh. So 6 lakh into 3 divided by 10. Why 10? Because 3 plus 7 is 10. Yeah, so 3 divided by 10. So we get 1,80,000 as the pre-cost of sales. So how can we find post? Simple, just subtract it. 6 lakh, that is the total cost of sales. Total cost of sales, yeah, minus 1,80,000, the pre-sales, pre-cost of sales. Then you get 4,20,000 as the post cost of sales. Simple. Yes, very simple. And then we have salaries. Now what are salaries? Salaries are fixed expense, isn't it? Salaries is fixed expense, and we always allocate, we always distribute fixed expenses on the basis of time ratio. On the basis of time ratio. Why is it fixed? Because we have to pay the salaries every month, right? It is not related with sales. It is fixed expense. You have to pay the salaries of your employees every month. It's a regular expense. So salaries is what? It will be done on the time ratio. And the time ratio is what? Time ratio is 1:2. Time ratio is 1:2. So let's calculate 60,000. Yeah, 60,000 is the total salaries. See, salary is 60,000. So 60,000 into 1 divided by 3. Why 3? 1 plus 2 is 3. So divided by 3, that is equal to 20,000. So 20,000 goes to pre. Yes, 20,000 goes to pre. And if 20,000 goes to pre out of 60,000, then whatever remaining that is there, it will go to post. Yes, 20,000 minus 60,000, it is equal to 40,000. Simple. Yes. And then we have rent and taxes. Now rent and taxes are also usually done on the time ratio, but for rent and taxes there was adjustment in the question, right? Rent and taxes, there was adjustment in the question, and the adjustment was that they said for the first 4 months the rent was 1,000 per month. Yes, so 1,000 into 4, that is 4,000, and the rent and taxes were given in the question as, see, rent and taxes 23,000 was given in the question. So rent and taxes were given 23,000, and the adjustment said that for first 4 months the rent was 1,000 per month. So 1,000 into 4, because 4 months they said, so 1,000 into 4, that was 4,000 rent for the pre-period. 4,000 rent for the pre-period, fine. And then they said the rent was increased after this date, after 1st August. Yeah, after 1st August the rent was increased to 2,000 per month, right? And if for 4 months it is 1,000, then the remaining, what is the period? 8-month period, right? So for 8-month period the rent was 2,000 per month. So 2,000 into 8, that is equal to 16,000. So 16,000 was the rent of the post period, right? But when we added 4,000 and 16,000, we found out it to be 20,000, but rent and taxes is combined, it is 23,000. So we come to know immediately that 3,000 out of this 23,000 is what? It is taxes, and taxes is what? It is allocated on the time ratio. So we allocated the taxes on the time ratio, right? 3,000 into 1/3, 3,000 into 2/3. Why? Because the time ratio is 1:2, right? So 1/3 and 2/3. So we found out the taxes of pre-period is 1,000 and the taxes of post-period is 2,000. Yes, yes, but now here rent and taxes is combined, right? So this also you can combine or you can keep them separate also. First you can take rent 4,000 and 16,000, and then you can take taxes also separate, 1,000 and 2,000 pre and post columns, or you can combine them, 4,000 plus 1,000, okay, that will go to pre, and then 16,000 plus 2,000 of post will go to the post column as 18,000. 16 plus 2 is 18, right? See, 16 plus 2, that is 18. So 18,000 will go to post column. Simple, you understood, right? 5,000 and 18,000 will go to the pre and post column. 5,000 and 18,000 will go to the pre and post columns. Simple. All right. And then we have general expenses. Now see, general expenses, miscellaneous expenses, all these expenses are fixed in nature. They are fixed because they have to be incurred. Okay, they are not related with sales, they are not related with turnover. So you have to allocate them, you have to divide them on the basis of time ratio. Fine. Now here in the question it is given general expenses 8,700, right? So 8,700 has to be allocated upon the time ratio. So 8,700 into, that is the time ratio is 1:2, so 1 divided by 3, that is equal to 2,900. So 2,900 will go to the pre column, and then the remaining, see, 8,700 the total general expense. Yes, 8,700 the total general expense minus the pre general expenses, that is 2,900. Yeah, you get 5,800 as the post general expenses. Simple. All right. And then we have discount allowed. You see discount allowed. Now discount allowed means we allowed the discount on sales. Okay, it is discount on sales, so it is directly related with sales, so it will be allocated upon the basis of sales ratio. Okay, discount allowed, advertisement, and then what is the carriage outwards, all these expenses are directly related with sales, so they will be allocated upon the sales ratio, and sales ratio is 3:7. Yes, so the total discount allowed is 8,000. Fine, discount allowed is 8,000, so let's allocate that. 8,000 into 3 divided by 10. Yes, 3 plus 7, 10, that is equal to 2,400. So 2,400 will be the pre-discount allowed. Yes, pre-discount allowed. And then the post-discount allowed, let's find out. 8,000, the total discount allowed, minus the pre-discount allowed, that is 2,400, comes out to be 5,600, which is post-discount allowed. Simple. And then we have formation expenses and interest on debenture. Now formation expenses. Now what are formation expenses? Formation expenses are the expenses which are incurred to create the company, right? They are incurred to create the company. And then we have interest on debenture. Now who can issue debenture? Only a company can issue debenture, nobody else, right? Can a partnership company or a sole proprietorship business, can they issue debentures or shares? No, they cannot issue any securities. Only company can do that, right? So this is company expense, this is company expense, both are company expenses. Fine. Formation expenses also, interest on debenture also. 4,800 and 1,400 will directly go to the post. They are exclusive expenses that will directly go to the post column. Simple. So interest on debenture and then formation expenses, both of them will go to the directly, they will go to the post column. Okay, post. Simple. All right. And then we have interest to vendors, right? We have interest to vendors. Now for this expense also we have prepared a working note, that is working note number 3, right? And in that we come to know that the payment was made on 30th September. So till 30th September, 6 months interest was generated, right? 6 months interest was generated. So out of that 6 months, 4 months interest was generated in the pre-period and 2 months interest was generated in the post period, right? So 4 months interest will go to the pre and 2 months interest will go to the post. So now we had to calculate. So how did we do that? 6,000 the total interest, and we want only 4 months interest in the pre column. So 4 months divided by 6. So 6,000, we want only a 4 divided by 6, that is the total months, and then we found out 4,000 will come to the pre column. And then post, what we did, 6,000 into, we want of only 2 months, so 6,000 into 2 divided by the total months, that is 6 months. Yes, 6 months interest was generated, so total 6 months, then we got 2,000 as the interest that was generated in the post period. Fine, simple. So that is what we did, and we found out that 4,000 will go to the pre column and 2,000 will go to the post column. Simple, right? 4,000 will go to the pre column and 2,000 will go to the post column. Simple. And then we have repairs to buildings. Now repairs to buildings will always be allocated upon the time ratio. Why? Because we assume that building was there throughout the whole year. It was there throughout the whole year, so time ratio. Simple. So now here we have repairs to buildings 8,100. So 8,100 on the time ratio. 8,100 into 1 divided by 3. Yes, that is equal to 2,700. That is the pre-repairs. Yes, 2,700 will go to the pre column, and then whatever remaining is there, that will go to the post column. See, 8,100 is the total minus the pre 2,700, you get 5,400 as the post. Simple. Simple, right? Yes. And now we have got all the expenses. All expenses have been finished. This is the net profit. This is not an expense. Okay, so this is the net profit of the whole year. So now what are we going to do? We are going to deduct all the expenses with the income now, okay, with the revenue. So now here we have got all the expenses. If you add all of them, you get 2,17,000, and here you get 5,03,000. And if you subtract, let's see, the income is 2,40,000. So 2,40,000 in the pre-column minus 2,17,000, the expenses of pre-column, 2,17,000, then you get 23,000 as the capital profit. This is the capital profit, and it will go to the capital reserve. Okay, 23,000 is the capital profit in the pre-column. Okay, this is the profit prior to incorporation. And then post, let's see in the post. See, here we have income of revenue of 5,60,000. 5,60,000 income minus the expenses. What is the expense? 5 lakh. Total expenses 5,03,000 minus 5,03,000. That is equal to 57,000. So the net profit, the normal profit is 57,000. Profit after incorporation is 57,000. And then this is the tally column. Yes, total column 2,40,000, 5,60,000, 2,40,000, 5,60,000. This is the balance, right? This is the tally column. This is the total columns. 2,40,000, 5,60,000, 2,40,000, 5,60,000. Simple, right? Okay. Now you understood, right, what we did? What we did? We found out the profit prior to incorporation, so that will go to capital reserve, right? And then the post profit will go to the profit and loss account. Yes, that is the net profit. It's a simple profit. So this is what we did. It's very simple, right?